Hello, everyone. Thank you for joining us today for this special series again. We've got a very special guest from all the way, darling, from United States, Thomas Hartman-Boyce. He's from the ARK Fund and has been with joined ARK since June 2021. He's currently serving ARK as a role of client portfolio manager. Thomas works directly with ARK investment team to communicate in-depth knowledge of investment level detail to internal and external clients. So you had a lot of experience prior to ARK as well. So Thomas was a vice president and a lead portfolio manager with the multi-asset solution business at Goldman Sachs Asset Management. Prior to joining Goldman Sachs, you were with also MSCI. And he held various client-facing positions there too. So a fair few things gone on there for you, Thomas. But really pleased to have you join us on the call. So thank you for your time and dialing in today.
My pleasure. Can't wait.
Thank you. So what we'll do is we'll go through some of the questions that some of our clients and advisors might have around the ARK Fund. I understand it is a disruptive technology fund that continues to invest in some of the emerging technologies for many years ahead. I've been a keen follower of the fund myself, and I trust many would have been during the period of coronavirus, given that Cathie Wood's presence was also quite widely known as well. And more so, I think these days where, AI is coming into a picture and there's a lot of, Tesla's coming, gaining good momentum, electric vehicle.
Yeah.
So, I think there's a lot of new thematic that our clients are keen to understand within the fund and what the investment strategy would look like. So maybe we'll start by discussing ARK Fund's approach to identify and invest in some of these disruptive technologies. What indicators does ARK normally look for when you decide those investment decisions?
Sure. Very good question. And I'll answer it in a few different ways. We really start from a top-down perspective. And by top-down, I mean analyzing technology, analyzing innovation, seeing if innovation is in its prime time state. And what I mean by that is our cost curve declines, making the technology very attractive, such that it's going to be adopted in waves based off those cost movements. And will that innovation impact kind of multiple sectors and have further technologies built on top of that? So that's how we look at innovation platforms, is what we call them. And to your point, any investment that we're ultimately investing in, whether it's in the public equity markets and some other funds we also have on the private side, we're looking for companies whose core competencies and technologies are certainly fitting that bill in terms of everything I just described from a technology perspective. So that would make up really 5 different innovation platforms. And you alluded to one of them already, artificial intelligence. Certainly one of the biggest opportunities that's out there. And I think performance year to date and excitement year to date, ChatGPT, et cetera. I'm sure we'll get into it, but that's one of them. The other 4 include blockchain technology, robotics, and various components of robotics, as well as energy storage. You could think of electric vehicles as the prime example there. And then genomics. And within genomics, it's inclusive of many different parts of life sciences, from gene sequencing to gene editing, and many other areas, including agriculture technology. So we're looking for companies that are certainly involved in those different technologies, but also are leaders in those technologies. So in many of these different markets, it's what we call winner takes most, in terms of having companies be leaders in their respective fields, having kind of early mover advantages, really dominating from a technology perspective, from a leadership perspective. And we, after screening from a top-down perspective using our research, we're then looking for those names from a bottom-up perspective. And that's ultimately how we create a portfolio. So at high level, top-down, and then the bottom-up selection in order to really create a portfolio.
And I think, probably, leading on to that, and some of the biggest concern that a lot of investors have is that high growth companies tends to come with obviously high reward in a longer dated perspective in the future. So how do you balance out those high risk component that is inevitable to be attached to some of these names that is sometimes may not be so profitable for some time? Like, how do you work that out and forecast those revenues ahead for the fund?
Sure. Great question. And similar to the last question, I'm going to answer it in 2 different ways. From a technology perspective, kind of a top-down perspective, we want to make sure, relating back to this cost curves, that we're not investing in a technology too early before it's ready to be scaled. So a good example of that is something like quantum computing. It's very exciting in terms of everything that's happening there, but it's not quite an equity market opportunity yet. Certainly there may be players that are going to be winners maybe 10, 12 years from now, but there's not enough opportunity there yet in terms of it being prime time in terms of where we are in the investment cycle. So we're looking for, again, areas where there's already adoption, where we use a 5-year time horizon. And within that 5-year time horizon, we have to see kind of meaningful revenue growth, and also the ability for companies to become profitable at least by that 5-year mark. So that 5-year time horizon is how we model individual names, which is quite important. But to your point, innovation itself is inherently controversial, and it's inherently volatile in the sense that you have players that are scrapping to become leaders in different areas. And ultimately, in terms of profitability, you're looking for companies that typically are putting money back into research and development, back into R&D, in order to compete, in order to win market share over that 5+ year time horizon. So in that regard, if you look at profitability and just simply look at a GAAP metric or IFRS metric, if you compare that to a value leaning index or even just a core position like the S&P 500, our names are typically less profitable, but you have to be able to model and understand the growth trajectory of these firms over a 5-year time horizon, and there needs to be profitability factored in. So to give you a little bit more detail there, for every name in our portfolio and names that ultimately don't make our portfolio, for considering them, we're modeling and assigning a price target using a 5-year, as I mentioned, EV, so enterprise value to EBITDA multiple. And we're assuming that in 5 years, that multiple is more or less equivalent to a more mature name in its category. So if we're talking about the IT sector, we're looking at a Google, for example, in terms of that multiple. So what that is really a headwind in terms of that multiple over the 5 years as it becomes more mature. But as you see pretty exponential growth in terms of the opportunity here, you tend to see profitability kick in. And I'll give you one plug here. We did release a paper a couple months back called Arc and Profitability. I can send it over to you, Johnny, in case you want to circulate it to the team there. But what's interesting, it says, okay, on first glance, if you look at the disruptive innovation portfolio, maybe this is a rough number, it'll fluctuate over time, but maybe 20-25% are profitable in a traditional sense. And in a traditional sense, you're assuming that R&D is just a lost expense, right? It's not an asset. Sales and marketing equally. And if you factor in, certain adjustments that we think make sense when looking at a 5-year time horizon, when looking at companies that are certainly involved in innovation technology, in our view, it makes sense to treat some of those expenses, in particular R&D, as an asset in the sense that you want companies that are out building a moat, building market share in terms of what they're seeking to do. And Tesla is a good example. But I think that at a high level, that's how we think about the world. It's a little bit nuanced based off the 5-year time horizon. But one other point I just add here quickly is that this is one of the reasons why there's such an opportunity in the public space for innovation. The typical investor in the public equity markets, as we all know, tends to be pretty short-term focused. And granted, with ETFs and the majority of public equities, you do have, daily liquidity, right? So it makes sense to focus on things and keep a short-term focus, at least monitor portfolios. But for innovation, you really need to have that 5-year time horizon. So what we've noticed is that many companies, they're not in the common indices that are out there. So our overlap between our portfolios and common indices, such as the S&P 500 I mentioned earlier, even the NASDAQ 100, is very, very low in terms of number of names. And the names in our portfolios tend to be kind of underappreciated and misunderstood because investors tend to take that very short-term time horizon. So in our view, it creates a market, it creates an opportunity. It will lead to volatility. And I can talk about how one can manage that volatility in a portfolio. But from our view, in terms of focusing 100% on disruptive innovation, it leads to a massive, massive investment opportunity.
Thank you for that answer. That's very detailed, and I think it's good that investors also be aware of those process that goes behind the fund itself as well. And I think Tesla, as you mentioned, it could be a great example. Obviously, they are definitely not that focused in the shorter term profitability per se. They're more focusing on the market share expansion, obviously.
Yes.
And
Yes, good example.
whoever bought the Tesla cars in the previous years, I'm sure they're not going to be too happy that Teslas keep coming down in prices. And me included, I haven't bought a Tesla yet, but I've been looking for it, and seems like the prices keep coming down. So it's a good opportunity for many investors to buy. But would you say that's one of the good examples, I'd imagine, that you mentioned as an example there?
I think it's like probably one of the best examples, and also something that's very misunderstood. So I've mentioned cost declines a couple times. We use something called Wright's Law, which basically states for every cumulative doubling in a unit produced, you see an associated decrease in cost and a consistent decrease in cost. So an example there is for battery pack systems, obviously the heart of electric vehicles. For every cumulative doubling of battery pack systems produced, you see a 28% decrease in cost. So what does that mean, to give real world examples here? Now the Model Y, I mean, it's one of the most popular cars in the world, especially in the US. But now with the Model Y, it's 10% cheaper than the average midsize SUV, and its performance is frankly fantastic. So again, it's those kinds of dynamics that we're looking out for. And a name like Tesla, in our view, is years ahead of the competition, probably about 3 years, based off their technology. And it's one thing to have exciting cars at a low price point, but relating back to technology and some of the different innovation platforms that I mentioned, energy storage is one of them, and that's obvious with electric vehicles. But in terms of robotics and potential for full self-driving, they are, no pun intended, well, maybe a pun intended, miles ahead of the competition. They're getting over 1 million miles in terms of recorded autonomous driving every 13 hours or so. So they've accumulated massive amount of miles, and that's proprietary data that's fed back through their algorithms that ultimately they can roll out at any given point. And obviously they're already doing that. But in terms of getting to full self-driving, autonomous driving, and the opportunity for robo-taxi networks, which we think is something that they're going to accomplish, it leads to a remarkable opportunity. So that's probably more than you even wanted on Tesla, because I moved beyond the sticker price. But
no, actually, no, that's exactly how much I wanted on Tesla, actually. And I probably want to ask a further question along that, because few, even amongst our advisors, as I mentioned previously, not just our directors here, also drive Tesla as well. So I think we're seeing some of that shift changes here in Australia, and Australia is one of the leading players for renewable energy on a personal home, with the solar panel, I think one of the largest penetration rate in the world here as well. So the battery packs are being considered in many households here in Australia too. So
that's fantastic.
Good to hear some of that feedback. Moving on from Tesla, and I guess a good sort of a segment to move on, given the AI and things are going around the world. Obviously, when our approaches investing in those emerging trends that's coming up in the future, I know previously, when before the ChatGPT release, ARK's been already focused on artificial intelligence anyway. But how does recent shift in this landscape change post the release of the OpenAI and large language models now being introduced? Was there any thesis, or shift in the company ARK's fund thesis or strategy that you had to rectify, given how quickly it caught up in the public attention and adoption rate by the consumers?
Yeah, great question. It's been fascinating year to date. To your point, artificial intelligence has been one of the platforms that we've been focused on since the inception of the firm, but a lot's happening. And, I was talking about cost curve declines. If you just look at annual cost curve declines for AI, you're seeing decreases in terms of the cost to train an AI model of about 70% per year. So what does that mean? It means for a name like ChatGPT, if they were to have launched ChatGPT in terms of an equivalent model in 2015, it would have cost over $500 million to create that model. They did it in 2020. It cost about $5 million. So you get a sense of those cost curve declines. And how much will that equivalent model cost in 2030? Could be about $500. If you can model the productivity uplift from AI, and our view is that by 2030, it's probably something like a 4.5x uplift. So what does that mean? I'll give you an example here. For programmers, for coders, the ability to have your code basically auto-completed, similar to when you're writing an email in Outlook. A very easy example of a neural network learning model, right? Language model. When you're writing an email, it kind of auto-completes the sentence. You can hit tab. You can do so with a company like Replit in terms of writing code. And if you actually look at efficiency based on folks that are using Replit, about 4 out of every 5 people are using on Replit's platform are using Replit and seeing incredible efficiencies in terms of code written and code produced. So that's just obviously one example. You could think about paralegals, even people in financial services, especially the Medicare medical system, in particular here in the US, because it's so fragmented and frankly horrendous. But many opportunities for productivity uplift, and it's probably related to a certain degree. But when you saw NVIDIA's numbers in terms of expectations for revenue, obviously incredibly exciting in terms of their forecast for $11 billion in revenue in the next quarter. So that's 40 billion annualized. And if businesses are paying $40 billion for these AI chips, there must be some downflow effects in terms of applications of those chips. So where are those going? Where are the software companies that we think will be beneficiaries of this technology? And I'll give you a few examples here. But from a hardware perspective, before hitting on software, what's interesting is a name like NVIDIA is trading at 25 times plus price to sales. And it's pretty remarkable for a hardware company to see that kind of multiple. To a certain degree, it's sensible in the sense that they're experiencing that explosive growth and they caught the market by surprise. But if you look at relative valuations, there's companies that I think are going to be key leaders in AI, key beneficiaries whose price of sales is more like 2 or just 3x as opposed to 25. And a name like that, it could be something like Twilio, Tesla, a little bit higher, kind of 6 to 8 in terms of price to sales. Be in the 2010s, you saw the shift from personal computers to mobile phones, obviously. And initially, it was those hardware players. And then you saw software players. I don't got to tell you, the Googles, the Apples of the world, and then eventually even the Metas, and then applications that you wouldn't even think were possible until you saw that software take off and the advent of that hardware. Names like Uber, for example, really become beneficiaries. So traditionally, you see these software companies have extremely high valuations relative to hardware. And here you're kind of seeing that flip. The script is flipped for a stock like NVIDIA. Again, a great name, and we do hold it in a number of our portfolios, but in concentrated portfolios in certain areas, we think there's other names like a Twilio that are exciting. And this goes back to your question, Johnny. It's like, well, what have we done? Well, we've taken a really deep look at where we think the value will accrue in terms of this AI opportunity. And we actually have a paper that's probably going to be released hopefully next week on our fund's website. So that'll be hopefully something that'll be interesting for folks to take a look at. But we're looking at companies from a software perspective that have proprietary data. A company like Twilio, just in a single year, did over 1 trillion transactions between its customers, so businesses, and their customers, so consumers. So think about the number of data points that they're collecting. And I mentioned the miles collected with Tesla. That's another great example. And you want companies that can use AI and really form a virtuous data feedback loop. So I'll give you an example. With Tesla, for all those miles that they're accumulating, it's having that proprietary data feedback loop that's incredibly important, and having that kind of distribution network intact.
Yeah, that was enlightening for me actually, because rather focus on the technology and the engine itself, you are also putting another layer of, does this company have proprietary data they can potentially make into something that could drive the company growth higher? Is that fair to say? When you do a sort of assessment, is that another layer that you really focus on rather than underlying technology as well?
Yes, yes. From a software perspective relating to AI, that's certainly the case. There will be names that, more hardware infrastructure related that we do like,
Mm,
that may be in portfolios. But to your point, from a software perspective, in particular, names that we think are just completely misunderstood now, that's where we see a lot of value. And to a certain degree, it makes sense that people aren't fully understanding this because again, going back to your point and as well as some of the points I've made, it's an incredibly fast-paced landscape. There's a lot to
mm,
digest. So I think a lot of people are kind of doing similar research and try to understand where the value will accrue for AI. But again, based on valuations today, we think it's a misunderstood opportunity, but albeit an incredibly large opportunity. And what you're seeing now, Johnny, is probably boards telling their CEOs, you need to do more on AI. What's your AI game plan? The CEOs
mm.
going to their COOs or CTOs and saying, what are we doing here? Mention it as many times as you can on the next earnings call, the next IR call. So to a certain degree, you need folks that have AI expertise in terms of understanding how to value these AI opportunities. And frankly, I don't know if this is one of the questions we were going to get into, but just to give you a quick 2 minutes here, that's frankly how we formed the team. So we're looking to
Mm.
hire folks on our research team that come from these domains that they're ultimately researching and investing in. It's much easier to teach someone with a genomics background how to value stocks, especially when you're, teaming up with a collaborative environment at ARC with Kathy, et cetera, than it is to teach someone with financial experience how to do gene editing, right? So we want people that have that lab experience to come in and to understand how to invest, and that's how we approach everything, including especially AI, in terms of having
Mm.
our director of research, Frank Downing, having a background in AI hardware, and then he's very well complemented with William Summerlin, who has a very strong background. He launched his first company when he was in high school. That's an AI cybersecurity firm that got bought out. In his expertise in AI software, and them two working together from a collaborative perspective. So it's important to have that view from a technology lens in terms of evaluating these opportunities. But again, keeping a valuation framework in mind, because there is a lot of moving pieces.